Hello, everybody. Luke Gromen, FFTT. Hope you're well. Hope everybody had a great weekend. I know I did. I was down in lovely Columbia, South Carolina, watching a little college baseball where the Marietta Pioneers swept the SUNY Cortland Red Dragons in a three-game series. So weather was beautiful. It's nice to get some sun, which is in short supply in Ohio this time of year. So with that, I'm going to jump right into the update. A lot of questions about the banks, etc. I think the banks are fine. I think most of the banks are fine. In my view, it's important to take a step back. This is a Treasury issue. This is a U.S. Treasury bond issue. This is the binary outcome we've been talking about for a long time, which is it's not a dial anymore. It's a switch. It's depression or it's inflation. Powell has to choose. Does he want to be Benjamin Strong over tightening into the Great Depression, or does he want to be Arthur Burns and see sustained inflation? And if you take a step, why I say it's a Treasury issue, let's take a step back again one further, which is the two biggest marginal buyers of Treasuries over the last 8 years really have been the Fed and U.S. banks. The U.S. banks over the last 8 years. And so obviously with QT, the Fed turned seller of Treasuries. The issue is ultimately that the U.S. government is de facto crowding out its own banking system by virtue of running these deficits, increasing these deficits thanks to the Fed raising rates and reducing tax receipts as the Fed is trying to fight inflation. So this in turn forces banks into a tough spot that we've all heard a lot about in the last week, which is, not even the last week, in the last 5 days, which is they either need to raise deposit rates to compete for scarce dollars for funding, but that in turn squeezes net interest margins and earnings for banks, which is a suboptimal outcome for banks and for stock indices more broadly. Or they need to issue a lot more equity to replace deposits that walk out the door into the Treasury market, into money market funds, which is essentially the Treasury market, to replace that cheap funding. This also hurts bank stocks and bank management net worths. Or the Fed and Treasury, Fed/Treasury, needs to help the banks by lowering funding costs by either cutting rates, the deposit guarantee program, whatever you want to call it, we saw this weekend, or by weakening the dollar, which, as we saw in October, Treasury did. Treasury helped lower the dollar in our view. And we saw immediately in the ensuing 3 months, Treasury yields came down. So that pressure on Treasury bonds on banks' books lessened. Obviously, if/when Fed Treasury does this, in our view, the release valve then is higher inflation for all of us. Some people think the Fed will keep tightening despite this, and that will ultimately essentially send deposits from small and mid-sized banks to just the biggest, too big to fail banks. I would concede that's possible. With that said, that's basically burning the furniture and the floorboards to stay warm. That's going to lead to these banks joining the Fed, who is QTing, selling bonds, foreigners who, with the strong dollar, are selling Treasury bonds, Treasury, who, with rising rates and rising interest expense, are selling more Treasury bonds. These banks will, in turn, if they have cash calls going on, they will sell bonds and lock in losses, which is not what they want to do, I would suspect. But ultimately, if gun to their head, that's what they'll do. And so you're going to have all these, and remember, the two biggest marginal buyers of Treasuries over the last 8 years are Fed and banks, and they will both turn seller, along with the U.S. Treasury, along with foreigners, at a time when the Treasury Move Index, it's a volatility index, it went out Friday afternoon at 140. The creator of that index back in October said once that thing starts nearing 150, it means the Fed's lost control of the Treasury market. So you can see the issue here. In my view, it's not a bank issue. It's a Treasury market issue. It's also a political issue. It's easy to say, the Fed's going to keep tightening and they're going to basically squeeze these small and mid-sized banks out of business and send the deposits to the too big to fail banks. Take a look around your community. Take a look at the small and mid-sized and regional banks and look at what they fund. Look at what they support. They're massive political supporters across the Senate, there's huge political lobby across the House of Representatives. You don't think they'll be on the phone to their congresspeople? I do. Then you layer on, look at the potential earnings and employment hit if that playbook is followed. They squeeze the small, mid-sized banks out of business, send the deposits to the big banks. You're going to end up hurting U.S. tax receipts. You're going to end up hurting U.S. stocks. You're going to end up probably having more treasury issuance into a world where, again, your two biggest buyers of treasuries, Fed and banks, are going to turn sellers, and the Treasury is going to be increasing the pace at which they're selling. It brought up the question, is this the pivot? I think the Treasury pivot was, as we've talked about, was in October. And in my opinion, yeah, this is the Fed's pivot. Do I think this is a Lehman or a Bear Stearns moment, as somebody asked? No, I don't. I think this is a reacceleration of the secular inflation that has been baked in the cake since COVID was dealt with the way it was dealt with. The Fed's the only balance sheet able to supply the needed liquidity, regardless of whether they call it QE or not QE or whatever alphabet soup they're calling this discount window platform lending program, whatever. It's more dollar liquidity. So to me, I think it's a big moment. I think it's a big moment. Now that begs the question someone asked, is this the time to unbalance the barbell strategy we've been talking about for so long in terms of a lot of cash and short-term treasuries and then overweight some inflation plays, gold miners, Bitcoin, etc., commodities, industrial equities? A little bit, but pigs get fat, hogs get slaughtered. I think it's important to understand our operating environment, which is nobody alive in trading has ever seen anything like this on a number of fronts in ways we've talked about before. And so I would not advise anyone going all in on anything. I think it's going to be very important to maintain cash and liquidity because this process is very political, and it's likely to get more political before it gets less political, particularly when you start layering in wild cards like peak cheap energy, what's happening geopolitically, etc. So last question is from CM. Speaking of geopolitics, what do you make of the rapprochement between Saudi and Iran in terms of power dynamics within OPEC and versus the rest of the world? Short term versus long term, I'd expect more coordinated policies and higher oil across the curve set par. To me, I don't have a strong opinion on it yet. I think it's very interesting. I think it's a very important thing to note, especially given the involvement of China in brokering that rapprochement, if we're to believe what we've seen across the news wires. I think it's further interesting with Xi going to Moscow next week on the tails of this announcement, and reportedly meeting with EU leaders after that. So let's just say I'm watching it with great interest. It has a potential to be important. We'll see. No conclusions yet other than this conclusion, which is it does not fit with conventional wisdom of the narrative here in the U.S. that we get from a lot of the mainstream channels for our news. So at any rate, I will pause there for today. As always, thank you for joining me. If you like these updates, please check us out, FFTT-LLC.com, for more information about what we're up to, as well as more information about our different institutional and mass market products. If you like these updates, you love tree rings, 10 most interesting things, quick synopsis on what grabbed us about them and whether they confirm or refute a way we'd previously been thinking about things. So with that, thank you very much for joining me. Everybody have a great rest of the week. We'll talk to you soon. Take care.